Welcome back, personal finance students. Let's just dive right into this explainer. Because today, we're going to completely shatter your mental model of what a bank account actually is. As students of finance, you're totally used to looking at interest rates, budgeting, the magic of compound growth. But today, we're pulling back the curtain. We're going to look at the actual fine print. Those dense sections of your bank agreement that start with, notwithstanding the foregoing, the pages literally no one ever reads? We are going to examine the hidden, grinding legal infrastructure that's operating on your savings in those rare moments when you actually stop to think about your banking relationship.
So let's start with a very specific number, $20,000. We're using this exact amount because holding 20 grand in cash triggers some seriously hidden legal mechanisms at major banks. And here's the kicker. Almost nobody reads about them. Now, to be crystal clear, this $20,000 threshold, it doesn't appear in any federal statute governing deposit accounts. It's not written into FDIC regulations, and nope, it's not a Bank Secrecy Act trigger either. Instead, this specific dollar amount matters entirely because of how retail bank profitability models work behind the scenes. Basically, the second you cross this threshold, the bank categorizes you differently. And that agreement you signed, it grants them specific, sweeping rights over your money, and they have absolutely zero legal obligation to tap you on the shoulder before they use them.
Just think about the stark contrast here. We have this comforting, almost cozy illusion of a bank as a passive, safe vault. But the reality is a lot harsher. It's an active, gear-turning legal permission structure that you actually signed. Honestly, I think the absolute most dangerous financial assumption you can carry into your planning is treating your account agreement like a simple, passive service contract. Because it's not. It is an active permission structure. These two mental models, a passive vault versus an active legal permission structure, they produce completely different outcomes when your bank suddenly flexes a right you literally never knew it had.
Here's a quick syllabus for today's masterclass on these hidden clauses. We're going to cover the $20,000 threshold, the right of offset, losing access to your funds, systemic reclassification, and then we'll wrap up with some crucial financial homework.
All right, part one, the $20,000 banking threshold.
We really need to understand why this specific dollar amount matters so much to a retail bank internally and how it dictates exactly how they view you. Think about it for a second. If a bank holds your 20 grand in a savings account paying current interest rates, they're paying you out somewhere between $400 and $800 a year. Well, to actually make money on you as a customer, they absolutely have to deploy those funds into products that yield a higher return, like lucrative personal loans or mortgages.
Which brings us to a pretty deep irony. If you hold cash but you don't hold any debt, the bank actually classifies you as their least valuable category of customer. Seriously. Being super financially responsible, having no mortgage, no car loan, no rolling credit card balance with them, makes you what retail banking insiders call a deposit-only relationship. Because you're costing them money and interest but generating zero debt revenue, that massive agreement you signed on day one contains specific tools the bank needs to manage your relationship entirely on its own terms.
Moving right along to Part 2, Clause 1, the right of offset.
So how do they manage those less valuable deposit-only relationships? They rely on the fine print buried smack in the middle of your agreement. Listen to this exact phrasing. Whether or not that obligation is currently due. That is wild. That gives the bank the documented legal right to just take your savings to pay your credit card or loan at that same bank, and they can do it before the payment date or even during an active dispute. In plain English, if you owe money on a credit card or a personal loan issued by that specific institution, they can pull funds directly from your deposit account to satisfy the debt. No advance notice, zero. A credit card balance that isn't even due yet can be offset against your savings if the bank just decides it serves their interests. And, incredibly, this right isn't even suspended if you're actively fighting them on a disputed charge.
And listen, this is not just some theoretical risk. It's exercised so routinely that bank customer service departments literally have a standing, pre-written script for the angry phone calls it generates. You'd think this only happens in extreme bankruptcy cases, right? No way. One customer service rep at a major retail bank, who had 9 years of experience, by the way, noted that this happens with such incredible regularity that they handle these calls as just a normal, predictable part of their week. Customers call in, completely shell-shocked, totally unaware this clause even existed, mind-blown that the bank could just take their money without a court proceeding or a collections process.
Okay, on to Part 3, Clauses 2 and 3, which are all about losing access to your money. Now, while federal law does set minimum standards for when your funds have to be available, account agreements routinely extend the bank's hold rights way beyond those federal minimums under certain conditions. For instance, if a large deposit hits your account and pushes you over their internal threshold, the bank can slap a hold on it.
Your funds will be visible right there on your statement. You can literally see the money sitting on your screen, but it's entirely unavailable for withdrawal for up to 10 business days. Think about that. That is 2 full calendar weeks where your money is completely frozen. Oh, and the clock starts from the date of the deposit, not the day you finally log in and notice the hold.
And it gets better. Under Clause 3, a bank can close your account for absolutely any reason or literally no reason at all at any given time. But what most people never think through is the return mechanism. They do not just instantly wire your money to another bank. Oh no. The standard method is actually mailing you a physical paper check, like it's 1995. And then, that paper check has to be deposited at a completely different institution, which subjects you to yet another agonizing hold delay based on your new bank's policies.
So when you combine these offsets, holds, and sudden terminations, especially during a stressful economic environment, which is exactly when you'd most urgently need your cash, your practical access to your own money can literally vanish. You could find yourself in a bizarre situation where $20,000 is legally yours, theoretically available on a digital ledger, but practically inaccessible for up to 15 business days. And all of this happens at a moment you absolutely did not choose.
Let's look at Part 4, Clause 4, Systemic Reclassification.
I saved this one for now because you really needed the context of those first 3 clauses to grasp the sheer scale of the invisible infrastructure surrounding your money. Regulators require banks to maintain reserves against certain categories of deposits, basically money they have to hold on to rather than loan out. Well, deposit reclassification was this slick, invisible accounting maneuver running on ordinary savings accounts for years. It's kind of like a magic trick. While you were sleeping and your account showed zero activity, banks would use a bookkeeping trick to temporarily shift your balance into a totally different internal category. This legally reduced their calculated reserve obligations so they could deploy more of your money. Regulators knew all about it, but it was completely hidden from the public until the 2008 financial crisis briefly brought it out into the light.
Now, to be fair, no money was ever actually missing. The balance you saw with your morning coffee perfectly matched the night before. But this practice reveals something super profound. It reveals this massive, unseen legal machinery operating on your savings when you aren't looking. It perfectly highlights how much the safety of your accounts depends on institutional conditions that you, the depositor, have never once been asked to examine or approve.
Finally, Part 5, your financial homework.
Because treating your account like a passive service contract is a dangerously flawed assumption, here's how you're going to investigate your own permission structure today. I want you to go to your bank's website, dig up the section usually titled Account Terms and Conditions, and read the actual rules governing your cash. Go find that paragraph on the right of offset. Find the exact text describing how your funds will be returned if they decide to terminate your account. Check the hold periods for large incoming deposits. If you do this homework and uncover language that totally upends your assumptions about what your bank can and cannot do, let us know in the comments. Honestly, the gap between what these agreements actually say and what depositors think they say is just staggering.
So, I'm going to leave you with one final provocative thought. Do you truly know what your bank can do with your money? The clause you haven't read isn't waiting for a financial crisis to matter. It became completely, undeniably relevant the exact day you signed it. The only variable now is whether you'll take the time to discover it beforehand or painfully find out after the bank exercises it. Thanks for joining me on this explainer, and remember, always stay curious about the fine print.